Welcome back, China World Report viewers. Once again, it's a distinct pleasure to welcome Mr. Lawrence Pih.
Lawrence Pih was born in Shanghai in 1942. He moved to Brazil with his family in 1952, where he made a name for himself in the business world, leading the Moinho Pacifico Group, one of the largest wheat processors in Latin America. He studied philosophy in the United States, specializing in the works of Jean-Paul Sartre. After 50 years in business, he became a renowned expert in geopolitics and macroeconomics, focusing on relations between China and the United States.
To share his wisdom with us today on a very important topic, which is the U.S. economy, the current state of the U.S. economy, which ties into a lot of bigger geopolitical and macroeconomic matters. And I very much look forward to listening to what you have to say. And I'd like to start by asking you if you could give us like a overall view and perhaps even a historical background as to how the U.S. economy is doing and how it got there.
Yes, thank you for having me, Italo. The,
It's
the
a
U.S.
pleasure.
economy is a very complex economy. It's a huge economy, and it's been the dominant economy for the past 40 years. So we have to look at the U.S. economy and try to understand how it's structured. And I would go back a little bit and give you some idea of how the composition of the U.S. economy in relation to its GDP. The U.S. economy is about 85% service and about 14% industrial production, manufacturing, and about 1% agriculture. So we can see that predominantly is a service economy as opposed to a manufacturing economy, which is the case of other countries, particularly the Asian countries, which concentrate much more and focus much more on manufacturing than on services. So this is the basic structure of the U.S. economy. And the three realms of the U.S. economy uh, that are important to analyze are the healthcare sector, which accounts for almost 20% of GDP, and the financial sector, which accounts for about 8% of GDP, and the education in general accounts for about 5%. So these three sectors account for about one-third of the US GDP. And you can see that the delivery, the returns of these sectors are questionable, particularly in the healthcare sector. According to the studies that I've researched, the US spends a lot of money in healthcare and delivers modest and tepid results compared to the European countries that spend a lot also in healthcare, but much less than the US in as a percentage of GDP and produce much better results. The financial sector, we understand that the US is a basically financialized economy, and it accounts for about 8% of the US GDP, which is significant. The financialization is very important to understand because there is more capital dedicated to the financial sector than industry. And lastly is the educational sector. That's about 4 to 5% of GDP. And if you look at the PISA results, which is a form of evaluating the performance of students of around 15 years across, I think, 70 countries in the world. And the US ranks in the middle of the 70 countries, which, according to what they spend, is not a very, very promising result. So these are the structural components of the US economy. It is an economy that is dynamic insofar as it can produce growth, but this growth is more on the service sector than the industrial manufacturing sector. So now let's look at how this is funded. The US obviously has this tremendous privilege of having the dollar as the world reserve currency, and it's the most used currency in the whole world. And therefore, US can borrow much cheaper than other countries can. And the US Treasury market is the most liquid market in the world. There are about almost 30 trillion worth of US Treasury outstanding, of which about 9 trillion is held by foreign countries. So the foreigners are actually supporting the US debt by buying its treasury. And this is an extraordinary advantage because if you can borrow cheap and you have the other countries that have trade surpluses buying your treasuries or financing you, then it's a sort of a double whammy. On the one hand, you can print to pay your debt if necessary, and on the other hand, you can borrow cheaply. So this is a huge advantage for the U.S. economy. And we see that this is shifting a little bit. And there are other currencies which today are beginning to become more important and more relevant, particularly in trade and in investment. The Asian countries, particularly China, is expanding its bilateral trade and settled in yuan and local currencies and bypassing the dollar. The BRICS is also moving ahead with alternatives bypassing the dollar. The process will be slow. Dollar will not lose its preeminence for a long time yet, but it's beginning to show signs of a weakness. Today, the US debt, federal debt, is about $38.5 trillion. And if you include the local and state government, it's over 40 trillion. That's about over 130% of GDP, which is around 30 trillion. And it's a huge weight because the interest rate has gone up significantly in the past couple of years. And so what you have, the current situation is that the cost of servicing this debt, this huge debt, only in the federal level, which is 38.5 trillion approximately, is costing about 1 trillion a year, which is higher than the defense spending right now. I mean the official defense spending, not the off-balance sheet items. And it is said that the US economy increases its debt by about $1 trillion every 100 days. And of course, we also have to include the close to $2 trillion of fiscal deficit. And so this trajectory is clearly unsustainable. And if it moves forward at its trajectory, it is likely that the rating agency will begin to look carefully to see if they need to downgrade the US rating, debt rating, which would be very, very, very harmful to the US economy and will only cost more to finance. We also realize that the Federal Reserve has a command and control of short-term interest rate, but it does not have control over long-term interest rate. And this is a problem because the long-term interest rate, for example, 10 and 30 years is about 4%, whereas the short-term interest rate, the Federal Reserve will continue to cut the benchmark policy rate, I believe, to around 3% going forward. So you have a relief for short-term debt, but the long-term costs continues. And this is structurally difficult to get out of because the deficit and the debt continues to increase. So at some point, the lenders will begin to ask, well, should we would like to demand more, higher interest rate because the risk is higher. And if it comes to fruition that the rating agencies downgrades US debt, then it would be a big problem for the US economy because they would have to pay even a higher interest rate. So this is from the monetary and fiscal policy. It is unlikely that the fiscal deficit will drop very fast. And we have another problem right now is that the tariff that the Trump administration implemented is being challenged. And if by chance the Supreme Court rules against these tariffs will have to be refunded to all those that pay the taxes, or the companies that pay the taxes, which will be very messy and very complex. And it will again increase the deficit, of course. So you have many, many problems facing the US economy. And it seems to me that it's unlikely that near term, the US inflation rate can go back to the 2%, which is the Federal Reserve's target. And so they will have to, on the one hand, decrease interest rate because the economy is slowing down and unemployment's rising. And on the other hand, they still have the tail or the headwind of higher inflation. So the situation for the Federal Reserve is very, very difficult. And we are looking at the substitution of Chair Powell for another Fed chair, which would be more dovish, I would say. and more aligned with the Trump administration's view of monetary policy. So we'll have to see who's going to be the next Fed chair, and if this will tarnish the credibility of the Fed. If you go back a couple of years ago, you will realize that the Jay Powell Fed actually misread the market. They thought that the inflation would be transient and short term, and as a result, it lasted much, much longer, which obviously forced the Fed to increase policy rates to over 5%. And so you have all these headwinds facing the US economy. From the one hand, the US economy, they want to reshore, which makes sense. They want to onshore, which makes sense. They want to rebuild the manufacturing sector, which also makes sense. The question, of course, that can they do it? If you're a company and you're CEO of a company and you want to invest 5, 10, $20 billion in a new plant, you want to be very sure that there will be a market when the plant is ready to produce. And the only way that you can be sure is that you have protection from the government, either from subsidies or tariffs. So what happens to a company that is producing in the United States of America? First, they will have to be sure that there will be a market at the price that they can still have a profit, which means that they will have to have tariffs, protection. And what is the end result? The end result is that costs will increase for American consumers across the board. And so it's a very, very complex situation. If the cost goes up, the standard of living goes down. And if the cost goes up, inflationary pressure, which will force the Federal Reserve to increase interest rate, and they have the whole cycle all over again. So it's not easy. And not only that, does the US have the labor, sufficient skilled labor, to be able to increase the manufacturing? And I'm talking about high value manufacturing, not textile or toys or whatever. No, it's furniture. So you will need a across the board effort from the US government and from whole society. And the American people will have to understand that onshoring, reshoring, and rebuilding the American industrial capacity has a cost, and that is increase in prices. Now, if you are a market economy and capitalist economy, it becomes very strange that you will raise tariffs and protectionist measures to be able to produce at a cost that is compatible to your consumers and compatible to your domestic demand, obviously barring foreign imports from coming in because they can produce at a much lower cost. And it's not easy, but the United States of America is making an effort, and they are absolutely right to do so. Now, the only question is that how much it's going to cost and if it's viable, short or medium term. And my feeling is that it's going to be very difficult unless you simply shut yourself out from the world supply chain and say, okay, I want to be self-resilient and I couldn't care less of the other countries. I want to be self-resilient in everything, and it doesn't make any difference how much it costs to the US consumers or how much going to be inflation. On the other hand, you have another problem because the AI investment is huge, huge, huge. And that has been in the past 6 months, I would say, or even a little more, the main engine of investment. And the growth that you see is in part being pushed by this huge, huge of hundreds of billions of dollars investment. I think AI is very important, and I think it will bring productivity in the future. The question is that there are so many players now, and the market has a certain limit. And I am afraid that many of these investments will have no return and will eventually disappear. So if you are betting in AI, if you're lucky to choose the winners, fine. But if you are betting in AI and you hook up to a company that will eventually be destroyed or be eliminated from competition, then you will obviously suffer loss. So I think there's overinvestment, and I do not think that the investment is anywhere proportional to the returns that the AI right now is expecting. I do believe that will increase productivity, and I believe that it will also, as it increases productivity, it will reduce jobs. So you will have a problem that's unemployment even worse than it is today. And unemployment is around 4.6%. And I think that by 2026, it will probably go to above 5%. And so from the asset point of view, we need to also remember that the S&P 500, for example, is trading at around 40 times the Shiller index, which is the CAPE, which is the cyclically adjusted P ratio. And the median and mean of the same index is around 16. The medium is and mean is measured over a period of 180 years. So it's about double of what it should be in theory. Of course, we're in a different situation now. 2025 is very different from 1900. But even so, history tells us that it's overvalued. And the reason why it is overvalued also is there's not much alternative for investors outside of the United States. U.S. generates a huge trade deficit. So the countries that earn this trade surplus recycles it back to the United States of America, buying treasury and buying assets. And actually, ironically, the U.S. needs a trade deficit so that the funds that goes to the foreign country comes back to the United States, precisely to buy U.S. assets and, of course, U.S. Treasury, which helps the demand of U.S. Treasury. And since they need to finance the debt, this is definitely a positive aspect of the trade deficit. So ironically, the U.S. needs a trade deficit to be able to sustain the prices of Treasury and have demand for Treasury, which is about $9 trillion held by foreigners. So this is basically the structure of the U.S. economy going forward. And we can expect that unemployment will continue. The workers' earnings in real terms barely accompanies inflation. So you don't really have a significant real wage earning increase in the U.S. economy. And the resilience of the consumer today is being challenged because the automobile loans are huge, credit card loans are huge, and the student loan is about 1.7 trillion. And the mortgage rates has been going up in the past couple of years due to increase in uh, benchmark policy rates from the Fed. So you see that the consumer is stressed. And if you look at the total debt of the United States of America, which includes all levels of government, federal, state, and local, and includes all household and all businesses, it's about $106 trillion today. And the question is that will this ever be paid? And the short answer is probably not. It is huge, 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 huge debt, and it's almost it's over 300% of GDP. So what's going to happen? We don't know, but the prospects are not particularly bright. So all these are the challenges the U.S. economy is facing. And as we all know, every government that's in power wants to expand the budget spending. And when they're in the opposition, they want to decrease spending so as to make the incumbent look bad. And this has been traditional. And anybody that believes that the Republicans are fiscally more responsible is naive. They are just as fiscally irresponsible as the Democrats. Now, so this is the situation that you have. You have two parties which is at the throat of one another, a totally divided country, and you even have the polarization come to a point that I believe that the social fabric is beginning to be challenged. And this is what we see in this economy right now. And going forward, things will probably get a little dicey. I see that 2026 is a year of enormous volatility. I feel that maybe actually it's likely that the Democrats will retake the House of Representatives and even may even challenge the Republicans in the Senate. If the Democrats by chance wins the House and the Senate, we will see a lame duck Trump government for the second half of his second term, and nothing much will be done. And of course, knowing Trump, he will probably challenge and push the limits of his authority uh, to challenge that all institutions. How that will the outcome, we have no idea, but it's going to be disruptive. So, to make long story short, U.S. is facing tremendous challenges, and we'll see how it fares out.
Well, going on onto that train of thoughts there, I'd like to ask you how you think that how would you characterize the current economic policy the U.S. has, and is it appropriate given these underlying conditions that you have just described?
Well, the U.S. policy right now is mercantilistic. No, they want to protect their trade. They want to protect their own industries, and this has been going on in the history of world economics. You saw Japan do that. You saw South Korea do that. You're seeing China did that and continue to do so. Europe did that, and United States of America did that also. So it's coming back. The new the policy of mercantilism and protecting your own interests. So this will fracture the global supply chain, of course, and it will be disruptive. And in the end, world growth will slow due to these policies that major countries are implementing or about to implement or will continue to implement. Europe's another problem. European economies are in the dire straits. They have huge, huge problems. They had the US military coverage or umbrella, so they spend very little in military, but spend a lot in social programs, which the Europeans are accustomed to now. They are countries that have a tax load of 45%, and they have huge, huge social benefits from education to healthcare and all sorts of benefits. Now, the European population is accustomed to this benefit, and so now they have to spend more on military. They are asked to spend at least 3.5% in military and hardware and personnel, and another 1.5% in infrastructure. Can they afford it? Short answer is no, they can't afford it. Just look at the European countries' debt. It's huge. And debt to GDP is way over 100% for many, many countries. Three countries that are crucial in the European Union, Europe, I mean, Germany, France, and UK. And all three economies are in dire straits, in deep, deep trouble. So what happens to Europe? Now, Europe cannot be a engine of growth, and so they won't help global growth. The United States is in the same situation. Now, let's look at Asia. India is doing okay. China is doing more or less. 5% growth by Chinese standards is not particularly exciting, but it's at least it's growth. And with a stagnant population growth, you probably see per capita income increase, and that's a positive thing. So you have some Asian countries that are growing a lot better than European or US. And the Asian country exclude South Korea and Japan because they are in deep trouble also. So, make a long story short, you have a divergent growth path for different countries. You see a deterioration, significant deterioration of G7 countries. They are less relevant militarily, politically, and economically in particular. And you see a growing BRICS countries, more and more countries are beginning to join the BRICS either as a partner or as a member. And this group will increase their GDP in purchasing power parity. It's already 40% of the world, and it will continue to increase. And they will pretty soon have about half of the world's population. So you have some divergent trends in the world which are beginning to be more clearly defined. And this is what the Americans are facing, huge, huge challenges. And it's unclear how they will be able to navigate all these challenges.
And on that thread of more of a global outlook, what role do you see trade policy and global supply chains playing in the current U.S. economic environment? And how sensitive do you see the U.S. being to this global integration?
Yeah, global integration is becoming fractured, Italo. The trade policy that the Trump administration unleashed practically destroyed the continuity of the global supply chain. And so now you see countries wanting to be more resilient, quote unquote, and that means that they will somehow detach themselves from the global supply chain. They do not want to be dependent on other countries for anything. So this is obviously bad for economic growth worldwide, and this is even dangerous from a political point of view, because as countries become more isolated and do not support a global supply chain, they become more adverse to other countries, and their view of the countries more as a challenge rather than a partner will increase the geopolitical tension. And this is the trend that I see going forward, short and medium term.
And going back to what you mentioned before, sir, in your first answer about, this rating agencies perhaps downgrading U.S. debt. Do you see this as a more of like a posse, something that is basically a house of cards, wherein the United States and the rating agencies being mostly American, uh, most of the major banks and hedge funds and corporations, S&P 500, everything being based in the United States. Do you see this as the United States basically fooling the world as to the strength of their economy?
Yeah, well, the U.S. has been selling a narrative that the economy is solid and that they will continue to grow and it will continue to dominate the world economic system, particularly the financial system. And to a certain point, it is true that they dominated the financial system up to now. Now, uh, the rating agencies, the most important from a point of view of people believing, are the U.S. Rating agencies. So, for example, Fitch, Moody's, and S&P are widely consulted, and their rating is very important to move for markets. And they are U.S. institutions, basically, so they are obviously very friendly to the U.S. point of view. And if you look at it from a technical point of view, I've asked some economists that understand a little about rating, and they tell me that if the institutions were non-biased, you would probably see the U.S. About two notches below what it is right now. So if that is true, and I believe it's possible, then the market will say, well, wait a minute now. Despite the fact that these U.S. rating agencies rate the U.S. economy at a certain level, the reality is a little bit different. And if they believe that and they act on it, then they will demand more interest rate, which is would be a vicious cycle, as it will increase the debt, increase the deficit, and even worsen the rating.
And do you see any likelihood of that actually happening, or
If
will the farce continue?
It's not going to be easy, because the last time that the agency decreased the rating of the U.S., the government was furious at the agency. So I don't know to what extent the political pressure will be a conditioning of these rating agencies. And the problem is that the rating agencies don't have much credibility. Look at the subprime crisis, no? The rating agencies were rating some companies at triple A, and they went bankrupt. So the credibility of rating agencies is very relative. And however, it's something that everybody looks at. No, it's interesting that they believe in the rating agencies, and they know that it doesn't reflect reality. So it's difficult to understand what happens. But Wall Street is a different species of animal.
Yeah, I think some will say it's a rigged game, that Wall Street plays, and how the U.S. government and all these rating agencies play into it as well. And now looking forward into 2026, Mr. Pai, what and beyond, by the way, what conditions do you see that need to be in place for sustained non-inflationary growth and for some sort of remedy, some sort of betterment of these conditions that we described for the U.S. economy, which, as you said in the beginning, are definitely non-sustainable in the long term.
Yeah, well, when you speak of sustainable growth, given the current situation, I'm doubtful that there will be sustained growth to the economy. Uh, Actually, what would be good for the world is a global growth above 3% of GDP every year. But I see that as a huge challenge, and I do not believe, at least in the next few years, that we will see anything uh, close to a 3% plus GDP growth worldwide. And I think that the global growth will continue to be between 2 and 3%. And strangely, is that 2% GDP growth, world growth, is considered by many as recession. I'm not so sure why that they use the 2% number, but this is generally consensus that a 2% growth or below is recession, a world recession, probably due to population growth, etc. So it doesn't look too good that we can have anything close to above 3% GDP growth in a couple of years or 3 or 4 years, next 3 or 4 years. And actually, I see a reset of many economies, particularly the economies where the asset bubble is at the bursting point. If you look at the US equity stock market and you go back to the 2000 dot-com bubble and the great financial crisis bubble that burst, and then which was in 2009, and then the COVID at 2020, 21, 22, you see that this pattern that we are heading for another correction and significant correction. The currently S&P is at 6,700 something, and it's been on a vertical rise for the past couple of years. So I believe that there'll be a correction, and as the Magnificent Seven and all the investment in AI begins to decrease, I believe that there'll be a reckoning. So it wouldn't surprise me that we have a major correction in S&P 500 in the next 24 months. And that will affect household wealth. That will affect consumer sentiment, business sentiment, and it is sort of a snowball. It just gets worse and worse. We'll see what happens, but the pro the prospects are not very bright.
Do you see a recession in the making?
Yeah,
Theoretically, there is no recession yet, but people have been speaking about it for the last 2 years, I guess. And do you see that being official at any point soon?
yeah. Actually, the recession, I would go back to 2019, before the COVID pandemic erupted. Most economists and analysts that I spoke to were predicting a recession for the year 2020, 2021. And then came COVID, so the governments all around the world, particularly the United States of America, injected trillions and trillions of dollars to save the economy, and that averted a recession. Now the debt is several magnitude, order of magnitude greater than before. And so the fiscal room to wiggle is very, very limited. On the contrary, they need to shrink. And if we were talking about a possibility of recession back in 2019, and it never came to fruition because of massive fiscal and monetary policy, and now the fiscal and monetary policies are at the end of the rope, so a recession is definitely possible. And if it comes, it's not going to be a short recession. And if the governments go forward with another round of fiscal and monetary policy, a stimulus, then the problem will only get worse in the future. The world debt today, total debt today, of all countries, together is about $323 trillion. Okay. And you have probably an increase of 70 trillion over the past 5 to 6 years. That is absolutely huge. And the question that we all should ask ourselves is, will this $323 trillion ever be paid? And the short answer is it won't be paid. So it will be a haircut. For every dollar of debt, there's a dollar of credit. So the creditors will take a huge, huge, huge haircut. And that will bring the world economy to not a recession, but a deep depression.
Yeah, that's very it's not very good news that you're predicting here, Mr. Pai. But it's very likely, as they say, that chickens have to come home to roost at some point. So you can't live off the debt eternally. And my final question to you would be the tariff business that's been going on between China and the United States. Do you see that in any way, shape, or form assisting, if resolved and with a resolution that is mutually beneficial, which is a policy that China always likes to push forward? Do you see that in any way, shape, or form helping the United States prevent this kind of the seems looming crisis?
I'd like to turn the clock back to 2018 when Trump's first term started a economic war against China. China was not prepared then, and China just took the blows. So they started preparing from 2018 on, and 7 years later, today, it's a whole different picture. China is a lot more resilient, and China's economy continued to grow throughout this period. It has made tremendous strides in technology, and its economy, I would believe, it's a better shape than the initial stages of the property crisis. The Chinese economy today, the property sector is about 15% of GDP, and at the moment that the crisis erupted a few years ago, it was 30%. So the impact of the property sector on the economy is much less today. And I believe that they will be able to somehow uh, manage the crisis, although it has taken a lot of pain. It caused a lot of pain in the Chinese economy, but the effect, the negative effect, is beginning to fade. So China has decided that it will become more resilient, will become self-sufficient in technology, and they have made huge, huge, huge breakthroughs in technology. And today, China, in many, many domains, are superior to the United States of America. And this contest will continue. So the U.S. trade policy of tariff is having much less effect today. And China decides to fight back now. So when the U.S. Imposed tariff, they countered with the tariffs, and eventually they came to an agreement, but the U.S. continued. So the Chinese said, okay, we will cut all the supply of rare earth metals to you. And if they did that, the entire U.S. economy will stop. You know? Everything depends on rare earth. And if you don't have that, your economy just comes to a standstill, particularly in the military sector. And the U.S. government and Trump is realistic. They understand that they can't play the tariff card anymore because there'll be retaliation, and the consequences to the American economy is huge. And if I'm correct in my assessment of the economy that I expressed in the past 40 minutes, I believe that the U.S. is in no position to challenge China in the tariff war, and even in the technological war, and even in the economic war. However, the U.S. is still predominant in the financial world so far. So I believe that the U.S. will no longer use its tariff card, and there's also questions, as I said before, that it's being challenged by it's a challenge in the Supreme Court. And the Supreme Court may actually decide that these tariffs are in fact illegal, and that the administration, the executive branch, does not have the authority to impose these tariffs without passing by Congress. And so many, many things can happen. We don't know what's going to happen. We have to remember that the U.S. Supreme Court has a huge conservative majority, 6-3, six conservative and three liberal. So the conservative majority will time and again side with Trump. And that's a very, very powerful card that he has in his hand, in his sleeves. So we have to wait to see what happens in the future, but a lot of things will play out. What I can assure you that we will have turbulent times and interesting times. No, the curse that says, "May you live in interesting times." Well, we will be living in very interesting times, and I'm not talking only about economics. I'm talking about geopolitics and military. Insofar as military is concerned, I believe that Russia will win the war against Ukraine. The Europeans are going to seize or already have seized the Russian assets deposited in European financial institutions. And that is simply a form of robbing the sovereign assets of a country. This will have repercussions. Russians will retaliate, and other countries around the world will begin to ask themselves, well, can we trust the Europeans? What happens if we go foul with the Europeans? Would they confiscate our assets also? And that applies also to the United States of America. So the more sanctions and the more egregiously, egregiously illegal acts such as seizing the sovereign assets of a country will have its consequences and it will backfire. And you can see that why gold is going up. It went from something like 1,800 to 4,300. It's precisely because many countries are saying, okay, we better begin to hedge and diversify our assets. If this continues, there will be less demand for obviously treasuries and European government bonds, even Japanese bonds. So it will be a sort of a snowball going forward. And with the prospects of the European economies, which I call Europe is the economic sick man of the world today, with South Korea, with Japan particularly, and US, you see that the Western and their allies are in a rapidly declining trajectory. So my advice to all the investors for 2026 onwards is hedge your bets.
Well, funny that you say that, Mr. Pai, because about 2 years ago, when I had a conversation with you about investments, you had mentioned gold, and it went up significantly since then. And it's always a pleasure to hear you, even though I guess the outlook is not as positive. I like to end with the question, which I'll edit it into before. I don't want it to be the last question, but it's with regards to household growth. Just give me 1 second here. Let me pull it up. I forgot to ask it here. Since you know when you mentioned that the U.S. economy is a service-based economy and not industrial-based, 84% stays service-based. How resilient is household consumption, and what factors will determine whether it remains a support or it remains a factor of support or a drag on the U.S. economy, considering the current economic conditions?
Yeah, that's a very good question. We have to analyze the resilience of the household spending. And consumer spending has been a factor that has sustained the US economy. Don't forget the generous fiscal policies of the Biden administration, and to a certain extent also the Trump administration. A huge amount of money has been passed on from the government to the consumer, and that has enabled the consumer to spend. Now the situation is the reverse. We have a increasing unemployment, wage increases, real wage increases, barely keeping up with inflation. And also we have a problem that the government cannot keep on just reducing taxes or handing out checks. No. So the consumer resilience is being challenged. And if you look at the debt, consumer debt is very, very high, extraordinarily high. And default and delinquency is increasing. Just look at the auto loans and credit card and the student loans. You can see that the consumer is hugely stressed, no? And household balance sheets are anything but solid. And plus the fact that half the American population barely has a $500 cash reserve for an emergency. So what you're talking about is that the elite, the top 1 to 5%, has huge amount of national wealth and income, and the 50% or 60% of the U.S. population can barely have ends meet, and the disparity of incomes is just simply horrific in the States. And this is why you see the increase in what they call the death of despair and the consumption of drugs. The poor Americans see no future. There's no social mobility. The American dream is gone. Yeah. So the desperation and the despair leads to this huge consumption of drugs and suicide, yeah, and basically what they call death of despair. This is tragic for the Americans. And not only that, you have a problem, a racial problem, a very serious racial problem. You have 25% about Hispanics, 13 to 40% Black Americans, and 5% Asians. This population, except for the Asians, are growing at a much more rapid pace than white Americans. So eventually, 20, 30 years down the road, this will be the majority. You know? And the MAGA movement is precisely the white population wants to, as they say, maintain their identity and keep their country and not lose the country to other racial ethnicities. So, and this is another reason why they have curbed immigration to extent. And for the first time, 2025, the United States of America will see a population shrinkage because the population increase in the United States of America basically depends on migration. The natural birth, American in the United States of America does not compensate for the decrease in population. So we will see a population decrease actually. So when you speak of Japan, China, or other countries of Europe, population decrease, you are going to see this phenomenon happen in the United States of America, which is unthinkable, in the past, but it's a reality today. The American population is older than the Chinese population, and the average age, life expectancy in China is higher than the United States of America. So, irony when we talk about the demographic problem in the United States, in China, if we look at the United States of America, it's just as dire.
Yeah, you're absolutely correct. I think it's something that's very visible in every major American city. You can see the drug crisis, the opioid crisis, and poverty just in general compared to how it was, 10 years ago. And even though these are not, I guess, the best news, it's always a precise analysis that you give, Mr. Pih, and well, I'm
Yeah,
very
just
grateful for it.
if I may,
Sorry,
just one last point,
please.
Itigo.
Of course, sir.
The Trump administration has declared fentanyl a weapon of mass destruction. Now, if you have a
Yeah.
huge demand of this weapon of mass destruction, that's an internal problem. Now, perhaps the U.S. should begin to analyze why there's such huge demand. And if there's no fentanyl, then probably cocaine consumption will increase. It doesn't make much difference. No, it would cost more because fentanyl is much cheaper. And ironically, is that at least 10% of fentanyl is produced in the United States. It's not imported, it's produced locally. So if you begin to crack down on domestic production, at least 10% of the supply will be eliminated. No? So first problem, why do Americans consume drugs? How come they have come to the desperation of being the largest drug consumer per capita in the world? Now, why? These are the questions. It's not a matter of where it's coming from. Sure, it makes a difference where it's coming from. But the problem is that if there is demand, there will be supply. And the demand is there. And the problem is to ask, why is the demand there? How can we reduce the demand? And a simple answer is raise the standard of living of the 50% or 60% of poor Americans. In fact, interestingly, Washington Post years ago had an article that said that 1 in every 6 Americans suffers from food insecurity or hunger. Now, that is tragic of a country that's the richest country in the world. So there we have it. We have a long way to go, and the challenge for the U.S. leadership and government is humongous. And I hope that they get their act together.
Yeah, me too. As an American citizen and someone that have had that lived there for a while, I have seen this decline with my own eyes over the decades, and I didn't know this fact of 1 in every 6 Americans, and that's just unthinkable for a supposedly first world country. So again, I'd like to thank you, sir, for your wisdom, for your precise analysis as always. Though it's a little more somber this time, I think it's important for to share, and I look forward to having you again, where we can speak perhaps on a different topic, perhaps about geopolitics and the looming conflict that it seems with between China and Taiwan, and what's going on in Southeast Asia. I think that would be something important that I haven't picked your brain on yet, and I'd like to do so very much. And I'd like to thank you as always for being here with us, and I hope to talk to you again.
Italo, it's a pleasure, and it will be a pleasure to go on your program again soon. Thank you.
You have an open invitation, and let's make it happen as soon
Yeah,
as we can. I know it's the end of the year and holiday season, but hopefully we can get together soon again and have another one of these very profound and
yeah,
insightful conversations. I really
yeah.
appreciate it.
And happy holidays to you and to all our viewers.
Thank you, sir. To you as well. Thank you.